welcome to our webinar on investing for the future and talking all things managed investments. I'm joined by my co-host, Benolo. Say hi to your fans, girl.
Hi, everyone. It's so nice to be back. I haven't actually done a webinar in a very long time, so it feels very good to be back.
I like it. It's like Sandra Bullock making her comeback with this new movie she's in.
Absolutely.
So B, we're dressed up a little bit today. We decided we were going to dress up from like a different era. We thought if we could go back in time, what would we dress up as? So talk to me a bit about your look.
So I'm not sure if it's a 60s or 70s inspired look, but it's inspired by my grandmother. So, you know, the little like 70s style. Yeah, so this is my look today, going back in time, going back to how things were done. But I'm more curious about your outfit. I think this is like my look is like a look, you know, that is not so like, it's not old. People can still like wear it today. But with yours, I need to know more. It's so funky. I like the hair. Tell me more about that.
You are rocking vintage. Let's just say that. I'm a 90s baby, man. And I'm rocking a bit of like baby spice in this look. And I chose the 90s because that's when I first started getting pocket money. And I remember, you know, saving all my pocket money to buy Ultra Hair Barbie. Don't judge. And just today, I think everything we're talking about brings me to the point of like, if I could go back in time, what would I swap my pocket money or my Barbie spend on? And I would definitely go back and put all those R5 into a tax-free savings account. 100% that's what I do. And then maybe I could be on paid leave right now. But it's cool. I love my job, so I don't mind.
Absolutely. So I remember like how they used to save money in the 60s and 70s, putting R5 and R2 into like a Coke bottle. So if I knew what I knew now, I would have advised my grandmother and my mom to like not put their R1 in a Coke bottle, but into a tax-free savings account. But we're here to chat all about it today.
Yeah, and we're talking about managed products, guys. And those are things like unit trusts, ETFs or exchange traded funds, and bundles, which are actually managed portfolios. So we're going to get into it today because these are all amazing things that can help you towards your own plans for the future. And to kick things off and give us kind of a broad overview of managed products and why we think they rock and they're timeless. See what I did there? We're going to bring in Mr. Craig Turton, our head of wealth at EasyEquities, and he's going to kick things off for us. So Craig, over to you.
Thanks, Connie. Thanks, B. Both of you look amazing in your outfits. Love the rocking look for sure. So thanks to both of you, and thanks to everyone who has joined us on this Friday afternoon and giving us your time. As EasyEquities, we do hope that you learn and you take some tips from us, and you're able to take that into the future with you. Carl's will be listening to you. And what your parents and your grandparents should have done, sort of what 20, 30 years ago. Maybe they were quite limited in the choice that they had and what they could invest in those times. You know, if I think back then, maybe it was just sort of banking kind of products and maybe some insurance stuff. And in today's times, there's just so much choice, and there's just, so many different things that we as investors can look into and invest in. So it has become a bit of a minefield, and hopefully today's chat will be able to just make things a little bit more simple and guide us in the right direction. If I personally look back in the future and think of some of the mistakes that I made with my money, they're not pretty, but I'm going to share them if it's okay. I think the first one for me, when I was in my 20s, I kind of overspent on cars a bit. I didn't drive fancy cars, but I drove cars that were above my means, and I had to take out those beautiful things called residuals and balloon payments and things like that. And that just kind of ate away into my money because I was servicing that debt. And every time I wanted a new car, I'd have to take that balloon payment and transfer it over onto the new car. And I just could never, ever, catch up and become, free from, paying a car off. And if I think back, what I could have done with that money and invested it and just, use my car for what it is from getting A to B, I think, that is a mistake that I wish I could, go back to and change a little bit. Another one was I started investing when I was quite early, sort of in my very early 20s. I had debit orders going into my investments, but where I made a mistake is I was a little bit inconsistent with my debit orders. So if lifestyle got a little bit expensive and I needed to go on a jewel or I needed to go on this holiday, my debit order would take a little bit of a back seat and I'd stop my debit order to my investments, and that I think has impacted me a lot over the years, where what I do now is I make sure that my debit orders take preference and my lifestyle, really, comes second. So I make sure that I'm investing for my future before, looking at my lifestyle and expenses and things like that. So that could have helped me. Another one was another positive for me, and I think I do encourage a lot of guys to do it, is to get I call it like a money mentor. So somebody who you can trust, who has the same values as you, when it comes to money and finances, and just learn from them. Listen to them, watch what they do. Get some good habits kind of going. So maybe that's that has definitely helped me, which I started doing, when I was around 30, and I've benefited from that, immensely. But back to managed products and what they are, and Carl, I think they mean different things to different people. What is a managed product? But for the purpose of today, we're going to focus around the tax-free savings account and retirement annuity, and just discuss the ins and outs of those on a very easy conversation point of view. And then we're also going to dig a bit deeper into the retirement and the TFSA and look at what you can invest in within those two vehicles, and look at the pros and cons and what our investors should be looking out for when it comes to that. We're going to be talking a bit about tax. We've got a tax expert who's going to be sharing her knowledge around tax in those products. And I think a key to investing for your future is understanding the tax and the benefits that come with investing in vehicles that have, tax incentives, linked to it. So that's going to be an important structure and an important conversation that we're going to have today. So our speakers today, all amazing. They're all specialists in their roles. They're all, gurus, influencers, and, I can't wait to hear, some of the conversations that are going to go on today. And to wrap up from in my segment, if I haven't taken up too much time already, is I've been in the industry for quite a long time, and I've had quite a few conversations with investors and clients, and I was thinking, what is the most common statement that an investor would make to me? And what came up in my mind was, I wish I'd started earlier, or I wish I'd known this when I was younger. And I think that sort of statement encompasses what we're trying to do today, is take what we know now and learn from it and start doing it now and implementing it now. I wish I knew what I knew now back then. So let's learn from each other, and hopefully we can do that now. It's kind of like going to gym. It's like it's you go to gym and you don't see the results. But over a long period of time, if you're consistent and you're committed and you're dedicated, you're going to start seeing the results. And I think if somebody stays invested for a long period of time, you might not see the results in the beginning, but stay committed and keep investing, and you're going to see the results. So I think that's where a lot of learnings have come from, and hence the theme for our webinar, Invest for Your Future. So back to you, Carly and Bruno.
Thank you so much, Craig. Sure. Like you've mentioned that you've mentioned your own mistakes that you've done in the past and how you wish you could have done better. And we have futurists in our community, and we call them futurists is because they have started using these managed investments to build towards their own financial goals and towards their own financial futures. So these easy investors, they are within our own communities. They are the people that have equipped themselves with the resources that we have on our platform and, took that step and said, I'm going to do things differently. I'm going to invest towards my future. And these amazing people, are going to be sharing with us their own personal journeys with the different products on our platform, specifically managed investments, and how do they come about them? How do they start investing in them, and where they started to access them. So without wasting any further time, Carly, I know you're excited about this first futurist, who is David.
Drum roll, please. So guys, just before we kick things off with this next session, I wanted to say, so many of you have already started asking questions. I love it. We are actually going to have a Q&A session at the end of these kind of chats, and we'll go through your questions and we'll pick some out that we think will be cool to answer. We're also going to be picking the 10 questions that we get that we think are the best. We're going to give those people 100 Rand EasyEquities voucher. And on top of all of that, if you stick around till the very end of the webinar, we've got 4 1,000 Rand EasyEquities vouchers to give to the people who ride the course with us. You got to ride the course of your investment. So we're going to reward you guys for that. But yes, David is up. He's going to be chatting to Bongani, also part of our EasyWealth team. And David, just quickly, how do we pronounce your surname? Is it like the champagne? Is it Krone?
Yeah, it's exactly like the champagne.
I knew we were going to be friends. I knew it. I'll hand things over to you and Bongani.
Cool. Thank you so much. Bongani, you're on mute.
A bit strange, sorry. But yes, hello to everybody and welcome back to the future. Firstly, I'd like to thank our wonderful hosts, Carly and Bonolo. You guys are doing a wonderful job. Thank you for taking us back and for holding us down today. Next, I'd like to thank each and every one of you guys who are joining us today. I truly hope that you can walk away from this with some value. Last but not least, I'd like to thank and introduce our first guest again, a futurist, David. David, thank you so much for joining us again today and welcome. I hope this conversation is very beneficial, not just for us, but for everybody else listening. As Carly mentioned, David and I will be discussing bundles today. So before we actually get to that, David, can I ask you just a few questions, if you don't mind, just to loosen up a little bit? Why don't you just tell us a little bit about yourself? Like, what do you do for fun? What's your connection to EasyEquities?
Yeah. So I actually am a runner. I love running. And that's where I met the EasyEquities group. But my journey with EasyEquities started maybe a year before that, where I got a little bit obsessive with my investments and took a big deep dive into sort of educating myself about, what my options were, and what started off like quite a good decision. Then that almost became a hobby of mine and got slightly addicted, and would check my account every single day, numerous times. And then I met the EasyEquities team at the Arts Trail because they were sponsoring it. It was a fantastic race, and it was just so cool to meet them there. And we realized we had a lot in common. And I live in Cape Town by the mountain and surf and run, and that's me basically. And I'm really interested in sustainability and environmental impacts and ESG and things around that area and that space around investments. Yeah.
Perfect, man. You're like a full house, basically.
Yeah.
But it's really great, man. Like, firstly, I think there's no such thing as being addicted to your investments. If anything, you need to be, if you want to always make sure that keeping abreast with the market trends and everything else. So I guess it's safe to say that you're an active investor, you're not a passive investor. You're not the kind of person to be looking at your investments every once a month or maybe every 6 months. Is that correct?
Yeah, I tinker here and there, but usually with my investment decisions, I'm thinking like, it's not just for a month. Now and then, like, I have to say I was a guilty party in buying a Veng and waiting for like that bump up to 5 cents or whatever it might be, and then I was going to sell. But otherwise, I'm generally thinking like a few years' time. That's not to say that I don't check like what's happening and then read the news and like, why is it doing this? Why is it doing that? And maybe I need to sell this or I need to buy some of this. So I'm kind of moving it around, but it's not, I try and hold on if there's a big dip, and I'm always thinking long term.
No, perfect, man.
Yeah.
Before we actually get into the bundles, I just have one little quick question. I want to pick your brain. What do you think, and this is obviously a personal question to you, what do you think the most common mistake people make when they invest or when investing?
Well, I can sort of speak from experience, and I think my biggest issue was not starting and feeling like I needed to know everything before I started, and sort of telling myself like, oh, I'm going to one day like educate myself about investments and like where I need to put my money, and I can't do it until I have all the information. And I think acknowledging that I'm going to make mistakes along the way, and I'm not always going to get it right, that was a big win for me, I'd say. And then second to that, I'd say it's selling on the dip. Yeah. But
that's good. I think you actually touched on a very important point, especially the first one, because not starting comes in various different ways. For some people, it's as you've explained, it's not knowing where to put the money. For other people, it's just being reckless with their money and not really actually being disciplined enough to put away enough money to save for their retirement or for their future or whatever the case may be. But yeah, just a few small examples, which I totally agree with as well. Something that I wanted to touch on in terms of an investment mistake that a lot of people make, I would have to say it's diversification. The simple act of not putting all your eggs in one basket, excuse me, is a make or break scenario. For a lot of people. But fortunately, we're about to dive into the bundles, so we'll have a very nice discussion about how one can diversify their portfolio by getting into something such as bundles, a managed investment. So with that, let's just hop straight into the quick chat about bundles. What is a bundle? Tell us, David, in your own words, what is a bundle? What does it do? What does it mean?
Yeah. So in my mind, it's basically, it's a lovely way to diversify your portfolio and have someone help you to do that. So obviously we don't always have all the information at our disposal. We don't know, we don't have maybe the time or the energy or the knowledge to navigate the space as to who to put our money into. So these are managed portfolios, and there's someone there who's choosing ETFs and stocks on your behalf. And yeah, so it's also adjusted to your risk portfolio as well, which is really nice.
Okay, that's interesting. That's something you actually just said there. So just to confirm, so you're saying it's one portfolio and somebody's choosing ETFs and stocks or shares for you in that portfolio. Is that correct?
Yeah.
Okay, perfect. So I'm assuming the name bundle basically just, comes from, you bundling those instruments, so the shares and the stocks together. Is that correct?
Yeah, chucking it all in there in one option. And that's basically
it. Okay, perfect. And then what about if it was you, if you were a bundle manager, and you had to create your own bundle, what would you name it and why would you name it that?
Yeah, well, I'd have to resist naming it after myself, but I think maybe investing for a better future, something along those lines, because I would probably want to make it centered around the environmental, social impact of those companies, as well as a second thought within the bundle. And I think if we are investing for a better future, it's important to think about those things. What sort of future are you investing in? Is it, we all want to live in a good society, a well-functioning society. So, yeah.
Very correct. Very correct. I actually like that, man. When you do start up your own bundle, please let me know. So I'll definitely be the first investor. So, just following that, do bundles actually, do they follow any themes that investors need to be aware of, or is this just all based on your risk profile?
No, it extends further than just risk profile. I saw there's one by Emperor Asset Management, which looks at COVID-19 recovery, which I thought was really cool. Shows a bit of nuance, and they generally like centered around a certain thing. There's equity. There's some which like are just purely ETFs, so that's like really diversified. Some with, yeah, I suppose then the risk comes in, like those are less risky, and then you have the more risky ones, which is like just equities. And I like those ones, I have to say, because I feel like I can invest in ETFs and choose my ETFs, and those are diversified. But then it's quite nice to have someone that knows about the different companies choosing those companies on my behalf. So I quite like those ones. Slightly more risky. Yeah.
Very, very well said. Actually, since you've mentioned Emperor, there's a specific bundle in the USD account. For those of you who are unaware, we do have bundles in the ZAR, tax-free savings, as well as the USD and all the retirement funds. There's a very, very interesting one in our USD account, which is called Battle for Attention. And that's the name of the bundle. So the theme and purpose behind this bundle is that they invest in companies that actually battle for your attention. So the likes of Metaverse, Facebook, because people are always on Facebook, always on Instagram, always on Snapchat, whatever, companies that Facebook owns, as well as, sorry, I'm just losing my train of thought here, Google and Apple, and, those companies that actually grab your attention on a day-to-day basis, those are the companies that are, brought up in that bundle. And that was the thinking behind naming it Battle for Attention. And it's a very good bundle made by Emperor. I suggest that you do check out all the bundles and just read a little bit about, the manager's philosophy and the strategy and what the bundle actually entails, as well as the risk profile before you actually jump into it. There was something you actually just touched on now, David, that I wanted to speak about. So you did mention that, the bundles are managed and everything's stock picked for you and, et cetera, et cetera. My question is that once a bundle manager has made a selection of all these stocks and ETFs, does it just end there, or are there any changes that are made to the bundle by any chance?
Yeah, there are changes. There's periods where there's, I forget the word for it now, but
rebalancing, eh?
Yeah, it's rebalancing. That's right. And then the manager will either add or retract certain aspects of the portfolio and reshuffle things slightly if he feels it's necessary, he or she feels it's necessary. So yeah, and then I think that's really cool because it's not a static space. There's always changes in the economy, and there's changes in the market, and so that's really nice. Yeah,
I love that. That's actually very, very important for people to look out for. You definitely have to stay up to date with, how the economy is performing and how the market's performing, and any news, in order to keep up to date with your investments. I think that's just a basic level of understanding that you need to apply when you do invest your funds. But David, just a personal one for you, other than, financial value and, anything that you like specifically about the fund manager or the stocks inside, is there anything else you take into consideration when selecting a bundle?
Yeah, I think I've already sort of touched on it. I do look at like what the company actually does and what other value they maybe add in terms of their social impact or their environmental impact. I like to sort of I want to make money, but at the same time, I don't want to invest in companies which don't hold the same values that I maybe hold. So yeah, they often express this through like their ESG. You can sometimes get, there's an ESG framework often applied to companies and they're assessed on that. I also just read the news a lot, and I like to choose companies that are making strong commitments towards climate change, and I tend to move away from companies that aren't disclosing their climate change related issues. So yeah, that's something I look at quite seriously. And then yeah, if there's any negative things in the news, I take that into consideration as well. Yeah, and I think it's, there's a lot of opportunity as well when you look at that space. You look at electric vehicles, you look at renewable energy. There's strong value adds there if you look for them, and where, what are the metals, what are the ingredients that go into those things as well, and who's doing what in that space. So I look at all that as well. Yeah.
Perfect. You mentioned ESG. Can you, for the people who don't really know, what exactly is ESG? What does it stand for?
It's environmental social governance. Yeah, and it's kind of expected that companies report in their integrated reports or their sustainability reports on those certain aspects. And I think in South Africa, we've still got a long way to go in terms of how we report on those. And there's a lot of greenwashing that happens, which is basically saying like, hey, look at us, we're so amazing, we're doing all these great things. But in reality, they may be not sharing the nuances of how they are doing detrimental things in that space. So there's often a bit of a facade that's put out there. So you have to be quite discerning and take it sometimes with a pinch of salt, but there's also a lot of people doing really exciting things in those spaces. And yeah, so they're generally in the sustainability or integrated reports. So you have to look there. Yeah, and I think there's increasing pressure and to do that, and demands on companies to report on such issues. And in the near future, it may be that all companies have to disclose they have to do climate disclosures, TCFDs, which is yeah. So basically, like, what is your climate impact, and how does that translate to with monetary value as well? So that's quite cool. That might happen in the near future as well. So yeah.
Definitely. All right, Dave, thank you so much for your time, your wonderful insights as well, and investing for the future. I really do love that idea. I think we should, when you do start up and create that bundle, please, like I said, let me know. I'm ready to put some money into it. But once again, Dave, thanks again for your time, your insights, and for bringing all this information forward, to our investors, bringing it back to the future. And with that, I'm just going to pass it over to our hosts again. Thanks again, Dave.
Thanks, Bongani.
Cheers.
Sure.
Thank you so much, David, Krone, Kling, and you, Bongani, for giving us insights into what bundles are, how they work, and where we can access them. Up next, we had a futurist who's all the way in Ireland, but unfortunately, she is stuck in a storm, experiencing bad power outages all the way in Ireland. But worry not, we have our head of ETFs, Sean, who's going to give us more insights on what exchange-traded funds are, how they work, and where you can access them. Over to you, Sean.
How's it, everyone? Sorry for the delay there. Thanks for the intro, B. And I'm sorry that Calypso couldn't be here today. I'm a lot uglier than she is. And it's unfortunate, but I'll do the best I can, Calypso, in your memory. And it's really lucky to be here. And it's amazing chatting about ETFs. I really enjoy them. And it's, I think, the best benchmark for people to start investing. And the first thing that people should be doing, as well as everyone should be doing it consistently through their investing career, I suppose, in their whole lifetime. Bobo, it's great to be chatting to you also, Bru, having some real insightful and clever guy to chat to, much cleverer than I am, that's for sure.
I think we need to take that back. You the ETF guru, I'm just Mr. Pretty Face, eh? You Mr. But yeah, man, Sean, thanks again for stepping in. I really do appreciate you filling in Gilletso's really big shoes to fill. I do hope that people are very happy with what you have to bring to the table. But yeah, man, Sean, listen, before we dive into things, I guess just the same way I did with David, I just want to break the ice a little bit, get to know you a little bit more and stuff. Recently David just told us how often he used to check up on his investments. My question to you is, how often do you check up on your investments, Mr. ETF Guru?
Although I do it quite often, probably every day actually. Obviously, working at EasyEquities, you're on your EasyEquities platform a lot, doing different types of work, but also just then while you're on it, just checking out what's happening, which is a good and a bad thing because markets move up and down quite rapidly. Hopefully, we always hope that move up all the time, but sadly that's not how life works. But it is lucky just to keep an eye on it every now and then and know, this one's moving. Maybe I must do some more research into this type of stock and check out what's happening there. So yeah, regularly.
Yeah. I mean, look, I agree with you. I'm also quite regularly checking it out. And I guess you're correct. I mean, it's a bit of a balancing act. Sometimes, you have the need to check, and you have the ability to check as well. But at the same time, checking every day and, minimal movements won't show you much of a change, and, could defer you from making, the correct investment choice of holding when you should hold versus selling when you're not supposed to, and, et cetera, et cetera. The conversation goes on. But another question, how were you first introduced into the world of investing? Like, what was the first thing you actually invested in?
So before I started at EasyEquities, which luckily I've been at this amazing company with all these really cool people you see on this call for 5 years, I was also a sportsman. I was in the sporting world, and I unfortunately didn't invest until I started at Easy. And then the first thing I actually bought was Purple Group. You join the company, you got to buy the share. Luckily I bought it. Obviously everyone has seen it do well, and obviously learned more about it as we go. But the second one I bought after that was an ETF. It was actually an Absa Momentum ETF. So try to get into that and learn a bit more about them and how they work.
Nice. I guess we have two completely different stories. My first experience with investing was when I was about 15. I received a mail in the post, and obviously I'm 15, I'm staying in my parents' house. I have no business receiving any mail. So this mail was addressed to me, and I picked it up, took it, and ran inside my room, ripped it open, and lo and behold, I received this little share certificate. No need to mention names of who I was investing with at the time and who I invested. But yeah, man, ever since that, I used to receive every few months, I'd receive another little check as well from them with dividends, obviously. And this was just how old things were back in the day. And that's how I was first introduced into investing. Since then, I was searching for something better to do and more ways to put the money in. And said platform that I was using had gotten a little bit better, but has fallen behind right now. So jumping into EasyEquities is just something mind-blowing compared to how the market used to be, and how I was introduced to it and how I remember it. In saying that, I was nowhere near understanding, knowing, or even thinking about an ETF. All I could ever think about, or all I was ever exposed to, was a share. And that's what everybody in my family as well, in terms of investing, was just putting money into shares and stocks. So, Sean, what does an ETF stand for?
But before I just jump into that, I think that's a really important thing. It doesn't matter really where you start, it's that you actually start and carry on investing from that starting point. I mean, in sport, they have that 1,000-hour rule. And if at the beginning, in the first hour, you're not going to be great. And only on the 1,000th hour will be really good. And I think that's the same as investing. You got to just get into it, learn about it, and keep going through the journey. So to jump into ETF is exchange traded fund. And it's a collection of shares, basically. I mean, ETFs track an index, and an index is basically a basket. It basically tracks like a segment of the market. So for instance, you get an S&P 500, which tracks the top 500 shares in America. You get a NASDAQ 100. You get the JSE top 40, which tracks the top 40 shares in South Africa on the JSE. And that's basically a nutshell what an ETF is and how it tracks it.
So tell me something. You just mentioned something very quickly about NASDAQ and S&P. So ETFs do offer international exposure. Is that correct?
That is correct. I mean, we obviously, being in South Africa and on the JSE, we have local exposure in quite a few ETFs, but also very fortunately, and that's why ETFs are so amazing, you get international exposure. I mean, you have ETFs, a lot of them track a lot of things in America, but you have ones in China. We actually, there's an IPO at the moment. The IPO just finished. The Satrix ETF is launching next week, and that's tracking India. So, it gives you exposure to all over the world, which is fantastic for us sitting down here and at the bottom of Africa and looking for different places to look in and touching all the different spheres, give yourself all the portfolio chances you can have.
Yeah. So just for clarity, because you've mentioned this word quite a bit, index, what exactly are you referring to when you say track an index? What does an index mean?
An index is basically a segment of the market. So it could be tracking, for instance, the JSE top 40. It could be topping the top 40 shares that are on that JSE, or it could be tracking the top 50 shares in India. So there's different type of indexes across the world, but it's basically a proportion of the market that it tracks. And that's what an ETF does. And it can be a number of things, like I mentioned the S&P 500, which is 500 shares, or it could be a smaller one like the JSE 40.
Perfect. What I really like about that, actually, that international exposure, is that you don't have to worry about all this admin of having to convert your money into another currency and worry about fees and then move it from one bank to another and then formally invest into that index. So you're saying that ETF gives you direct access to that index within your rand. So you can put down 100 rand and pretty much invest in something that is tracking the exact same index that's in America or India or China. Is that correct?
That is correct. And you don't have to go and exchange it to dollars. You don't have to do anything like that. It is in your rands and it stays in rands, which is, like you say, absolutely fantastic. And your ETF provides you all the backup stuff. I mean, obviously on EasyEquities, we also have a USD account where you can change $2 and buy USD ETFs as well as an Australian one. But the kicker is doing it in ZAR and staying in rands also. So, I mean, gives you all the options, gives you anything you want, you basically can have, which is, if you go back to your story of getting it in the mail, I mean, it's come a long way and it's absolutely amazing.
It's come a very long way, definitely. So look, Sean, I love that so much, man. But there's one more thing that a lot of people always like to question and query, fees. And that's a very, very big question. People always ask how expensive it is, how cheap is it? A unit trust and bundles, for that matter, they usually charge their fees on an annual basis. So that's charged in accordance with how much money you've put in that specific fund. So if you put in 100 rand into a unit trust or 100 rand into a bundle, the fees are charged in accordance with what that total net asset value is. Is the same applicable to ETFs, or do they work on a different sort of system?
They work on a system. It's called the main one that they're looking at is called the total expense ratio, or a TER. So each individual ETF has a different expense ratio. So, it's obviously when you're doing your research into the ETF, it's quite important to look at the different expense ratios across them, and that gets tracked annually and it's taken off a percentage of your fees. But I mean, they're very small. I mean, some of them, for instance, again, I'm using the top 41. Some of the Satrix one is a total expense ratio of 0.1%. So, it's not a lot, but again, it's make sure you're doing your research and checking which ETF has what fees. As well as that, you must just make sure that when you purchase the instrument, whatever instrument you're looking at on the platform, there is a fee for the platform. So on EasyEquities, there's a fee when you buy and sell the ETF as well as the shares. So just make sure that you understand that there's a cost for the actual ETF and there's a cost when you buy and sell it on the EasyEquities platform.
Perfect. No, I think that's very laid out cleanly and plain. So just another thing, what was the first ETF you bought? And why did you choose this one? So unlike Purple Group, we know why you bought it and we know when you bought it. So what about an ETF? What was your first one?
The first ETF I bought was the Absa Momentum one. And the reason I bought it is obviously I didn't know much about investing when I joined Purple Group back in the day when I was a bit younger, and hopefully
I think we might be losing you there, but Sean?
Tracking a great one to look at. So I just got started in it. I put a little bit of money in it just to check what happened and to see how it worked. So that's how I started. But there are lots of different ETFs to buy and track. I mean, you get dividend ETFs, which are absolutely amazing. Obviously, they give you returns. It depends on when the ETF pays. Sometimes every 3 months. So there really are a whole variety of ETFs that give you each type of meal that you want, which is really cool. So just to make sure that you check it. And the best way to actually check where ETFs are, and I'm going to punt our little site, is EasyETFs, because it lets you find the ETF that you want to, it lets you compare them against the difference. You can look at the different expense ratios, and that's where it is. So if you're looking for what ETFs to find, you can head on to EasyETFs and check it out. You can find the dividend ones on there. You can find anyone you want on there, which is amazing. I mean, on the JSE, we have 86 ETFs. And 76 of them are available in our tax-free savings account. And with the tax end coming up at the end of February, those are the ones you want to obviously look at the moment.
Wonderful. Actually, to add on to that, I had a very interesting question to ask you. But before I ask this question, I have a little bit of a story that I want to just kind of share with why I'm asking you this kind of question. I'm sure we're all aware of the Apple story. I mean, how they started the company in the garage, and a few years later, they listed the company. And today they are one of the, if not the biggest tech giants in the world. They certainly made a lot of their investors very rich, specifically those who decided to hold. And this is kind of speaking to a point that Dave and I spoke about a little bit earlier about, not selling when your investment is currently taking a dip. So my question to you, Sean, is what is your Apple ETF? What is that ETF that you will hold on to forever, that you see going all the way up and taking you all the way to the end?
So there's two ETFs, and I like that, I love that Apple story also. But there's two ETFs that I'll hold forever, and that is, the first one is the Satrix MSCI World ETF, and the second one is the Cautious Total World ETF. So just because they track all instruments from around the world and quite equally weighted in different markets. So that's why it just makes the diversity and my risk factor a little bit less. And that's also why I like ETFs, because you're not investing in a single share where we spoke about the market going up and down quickly and exponentially your risk factor. Whereas an ETF, because it tracks so many different shares and companies, your risk factor is a lot better. And that's particularly why I like those two, and those two I will always hold in my portfolio.
So you have two apples, basically, huh? Just two apples, just the two.
Okay. Just two. I'm okay with two. We can call
the more the merrier, which is good. It's all about diversification. At the end of the day, it's also about holding and just starting and preparing to invest for your future. But Mr. ETF Guru Sean, thank you so much once again for stepping in, filling very, very big shoes here. I think you definitely stepped up to the plate. Myself, as well as the investors on the webinar, we appreciate everything that you've given us today. Thank you so much, Sean.
Thank you, Bobo, and thank you everyone for joining us today. I hope you found the rest of it insightful. We have some amazing people coming up, much better than I am. So enjoy it and have a wonderful time.
Thanks so much, Sean. And thanks for chatting ETFs. I myself am an ETF geek. I was a little like, what are these things in the beginning? And now I'm literally obsessed. Bonolo, what's your favorite ETF in your account at the moment?
My fighter has been the Satrix MSCI World ETF. That is my favorite ETF, which gives me exposure to literally everything around the world. And I know that I'm diversifying my portfolio. So that's my fighter.
I'm the same. I have my MSCI World in there from Satrix, but I gotta say another heavy hitter in my account has been the Signia Fourth Industrial Revolution.
Right.
Was sure that thing's blowing up. It's been really good to me, and I love sort of being at the edge of innovation and seeing what's happening, and all the tech companies that are coming about. It's really interesting.
Absolutely. So Carly,
but we've touched on ETFs. But we haven't spoken a lot about unit trusts. Unit trusts are the new kid on the block, B. Mm-hmm. They arrived not so long ago, and they're already becoming the popular kid. So I think we need to hand over to Nozipho and Mungani again, and they're going to talk to us about unit trusts, and they're going to easy fire for us. So take it away, guys.
Yeah, thank you so much, ladies. Everybody, I promise you, this is probably going to be the last time you're going to see my ugly little face. Nozipho, thank you so much for joining us today and taking the time to speak about unit trusts. Welcome on board.
You're welcome. Thank you, Team Easy, for organizing this webinar. You guys are awesome. EasyEquities is my favorite platform, by the way. I post about you almost every day on my pages.
Love to hear it. Love to hear it. And in saying that, tell us a little bit more about yourself, eh? What do you do for a living, eh?
Okay, so my name is Nozipho Van Heerden. That's a story for another day. So I am a software consultant during the day, and in my spare time, I'm actually a personal finance vlogger and blogger. So I do have a blog, and I also have a YouTube channel, and basically, I was never clued up about investing. So the reason why I love EasyEquities is that it has simplified the way newbies invest. It's easy to understand and anybody can get started. So this is why I absolutely love EasyEquities. You guys are doing an amazing job.
Thank you. Thank you so much. So before we take it back, I want to just take it a little bit forward and speak about your future. What do you picture when you think of your own retirement?
So for me, retirement is not about age. It's about financial freedom. So usually when people think of retirement, they think, oh, when I'm 60 or when I'm 65 years old. But retirement for me is financial freedom. And financial freedom is having enough money to choose not to work. And it can happen much sooner than age 60 or 65. So when I think of retirement, I'm not necessarily thinking about my age. I'm actually thinking about I can stop working if I want to, or work for lesser pay in a more meaningful job, but I've got enough saved in my investments that I can take the salary cut. That's what I think retirement is, not necessarily old age.
I mean, you said you're a software engineer. Right?
No, software consultant. Woo!
Software consultant.
Software consultant.
My word, yeah. Now I think you should be a retirement specialist. I think the way you just put that basically was plain, cut, clean, and simple. I really loved the way that you explained that. You know, obviously everybody has their own ideas and thoughts about what retirement means or how it looks to them or how whatever. But I think the way you put it was very nice and simple, and it was just exactly what people should be working towards in terms of retiring for their goals and stuff.
Yeah.
So without any further ado, let's get straight into the questions. Because unit trust is the new baby on the block, as Carly so put it, we've got $1 million question here for you. What is a unit trust, Nozipho? In your own words, how would you define what a unit trust is?
Okay, so unit trusts have been around much longer than ETFs, actually. They're new on the EasyEquities platform, but in terms of being around in existence, they've been around much, much longer than ETFs. But basically, a unit trust is like a piece of cake. So a cake is made of flour, milk, eggs, butter, sugar, salt, and baking powder. Some of these ingredients don't taste very good on their own, but when you mix them together and bake them and make a cake, it can be very delicious. So basically, a unit trust is a mixture of investments that are sold to you in slices, and those slices are called units. So it's like eating a cake. You're not eating the entire cake, but a slice of cake which is made up of different investments. That's as simple as I can put it.
That is very, very well said. I must say, we've had numerous examples and of what unit trusts are in people's own words. Once someone had compared it to a swimming pool, another person had compared it to an ice cream, and your cake analogy, I think we're just going to run with that for the rest of it. Because there are millions and millions of different kinds of cakes out there, and not each cake tastes as good to the next person, but everybody loves cake. So everybody is going to love a unit trust. I love that. I was actually going to ask, how do unit trusts tie in your personality? And I feel like I need to make a joke with cake or something here. Do you love cake that much?
Yes, I love carrot cake. So my investor personality is that I'm a very laid back investor. So I don't like being glued onto my screen, watching the computer all day, because we've got life to live, right? We've got work to do. So I prefer to invest in something that will grow on its own with minimal intervention on my side and minimal effort on my side. So unit trusts fit in very well if you've got a very laid back personality, you don't want to stress too much about your investments, then you can go for unit trusts, because then somebody else is managing your investment on your behalf and your money is growing while you literally do other things that are more exciting.
Exactly. And that's a very good way to put it. You mentioned earlier that unit trusts have been around for a long time.
Yeah.
And to me, the way I always explain it is that, unit trusts are tried and tested. It's something that's been around for so long and it's still here, which means that it's doing something right. Something is right. Whoever is baking all those cakes has the ingredients down to the T. So in saying that, do you think unit trusts are targeted for people trying to make a quick buck? Or
No, I don't think so. Personally, I don't believe in getting rich quickly. I believe in getting rich slowly. And unit trusts are really great if you've got a view for the future. So today we're talking about investing in our future. And if you're interested in the future, then unit trusts are definitely something that you can look forward to. If you want to get rich quick, I don't think unit trusts are for you, basically.
Definitely. So what do you look out for then? When you're trying to choose a unit trust, what are the key factors that make you want to choose this or stay away from that one?
Basically, I look at diversification. By that, I mean, how many things does the unit trust have, or how a variety of things that the unit trust has. So it must have a mixture of things in there. I look at that, and I also look at fees. So unit trusts, because they are managed, somebody is doing the work, they're heavy lifting on your behalf. They don't do it for free. There is a small fee that they charge. But I always want to choose a unit trust that has got low fees as possible. So those are the two things that I look at in terms of choosing unit trusts.
Oh, that's good. It's actually quite funny. Most people don't really know what's actually inside a unit trust. And, to my knowledge, these are one of the most diverse instruments out there, because each unit trust also follows its own specific theme. So depending on the theme, it may invest in securities such as shares, bonds, ETFs, even properties. Ultimately, the fund manager of the unit trust will make that final decision as to what the actual weightings are within each product or within each cake.
Yeah.
So when you put money into your cake, or when you're about to buy a piece of cake or a slice, that slice will obviously get split according to all the weightings that are inside that specific fund. So if there's a fund that has 5% of it into properties, 10% into government bonds, 50% into shares, your 100 Rand will be split according to those weightings within the unit trust. And so it's very important that, before you make a decision about which unit trust you want to invest in, over and above looking at the name or the fund manager, no need to mention big names, but there are big names out there. Before you do that, it is very important that you do your own research and make sure you understand what you're putting your money into, and make sure you understand the fees as well. Nozipho put it out very, very clearly. The fees are a very big factor, but they are charged annually within a unit trust. So it's nothing to be like when you're buying and selling, you're going to incur so many fees because you're putting more money in, you're putting more money in. It's more on an annual figure based on all the amount of money, or your net asset value within that unit trust. So without trying to ramble and continue, Nozipho, I have one last question for you. And this is a very interesting one. All right. If I gave you the option to take either 500,000 Rand right now, but you have to invest it. You have to invest this 500,000. You can't withdraw, you have to invest. Or if I gave you 1 million Rand in cash to spend, which you cannot invest, which would you rather choose and why?
That's a very easy choice for me, because I would choose the first option, 500,000 Rand to invest. Because since I'm a numbers nerd, I love numbers. I ran a little calculation, and I figured that if I invest that 500,000 Rand, and if my investments compound, so if they grow every year by 10%, after 25 years, I'll have 5 million Rand. So I'll have 5 times that million that I would have spent. So definitely, if you're thinking about the future, long term, I would rather invest that money than spend it. And I'll be super rich. And 25 years is not so long. It's like the future is going to come sooner than we expected.
And ladies and gentlemen, there you have it. What a well-structured answer from our futurist. Nozipho, that was brilliant. I loved the way you laid it out. I love the way that you actually also put it into numerical figures for people. Because a lot of people say, I'd rather take the money because I'll do this, I'll do it. No, I love the fact that you put it out very plainly, exactly what you're looking to get out of the money as well. We can all take notes from Nozipho. That was brilliant. But Nozipho, again, thank you so much for your time and for sharing your insights. And ladies and gentlemen, with that, I'm sad to say that is all the time that we have for our futurists. We took a little trip to the past with each futurist, but we made sure to always bring you back to the future. If there's one key takeaway that I want to leave you guys with, it is this. Retirement is like a never-ending vacation. Apparently every day is Friday, but what I'm trying to get at is that nobody wants to stay in the cheapest hotel on vacation, right? So don't dip into your retirement savings. Don't cheat yourself out of putting money away, no matter how tempting it will be. That way you can always ensure that you will have a 5-star, never-ending vacation. And with that, I'm out. Ladies and gentlemen, thank you so much for tuning in and listening to myself and all three futurists. David, thank you so much. Sean, thank you for stepping in. Nozipho, thank you so much for that cake analogy. Over to you, ladies.
Phew. I feel like now I just want to take everything that I have and put it towards my retirement because, wow, that first part of the session, I am blown away and I'm inspired. Thank you so much to all our futurists from this first segment. And now you're probably wondering, where can I access all of these instruments? Like, where can I find them? Bundles, ETFs, we've touched on bundles, ETFs and unit trusts. You know, our futurists have explained what they are, why they decided to choose them, how they work and so forth. But now let's talk about where we can find these instruments. Now we're going to chat about your retirement annuities as well as your tax-free savings account, which are two wallets available in your EasyEquities account that you can use to find these products. So I'm going to introduce our head of wealth, Craig, as well as one of our faves, hashtag our Fin Twitter celeb, Soul Fairy, chatting to Craig about your tax-free savings account as well as your retirement annuities. So over to you.
Thanks, Bonolo. Thanks for Bongani for those insights into to ETFs and unit trusts. It was I learned a lot there. Soul Fairy, welcome. Thank you for joining us. It's great to have a celebrity with our community. I saw on Twitter you have in excess of 20,000 followers in your Twitter account. And I see that you are what you call an ambassador, or you like the concept of FIRE. So maybe if you can, just chat us through your Twitter success and FIRE.
Wow, you're gonna call me a celebrity? Please don't. Okay, so how I started is I created my Twitter account in the heart of lockdown, June of 2020. I didn't tweet I tried tweeting, guys, I really tried, but I felt like I was speaking to an imaginary friend. So then I vanished a little bit and I came back in January of 2021. So those 20,000 followers, probably they're gonna learn something. They think they can learn something from me. So it's just been over a year, guys, that I've been on Twitter and I've been talking about FIRE. And the reason for my account is when I got onto Twitter, I was absolutely shocked. And Facebook and those groups on Facebook, I was so shocked that people disrespect their own money so badly that they take their hard-earned money and they buy things that they know absolutely nothing about. And that absolutely shocked me. So I get up every day and I try my best to educate. It's all about education. I try to answer the simple questions, the hard questions. I mean, Craig asked me about tax yesterday, and I said, I'm not the best person to talk about tax. So I am so happy Lizelle is here later to back up if I say anything wrong on tax. But yeah, my Twitter account is for anybody that wants to learn, that wants to ask me a question. I am on my way to retire. I'm currently 43. I think I will retire officially when I turn 48, definitely before 50. I've been building this portfolio for the past 13 years. And as everyone has said before me, my biggest regret, not starting earlier. I made the same mistake Craig made, drove BMWs, drove GTIs, had residual values on them, early in my 20s. And I just think, I could be on a beach in Thailand right now if I just started a little bit earlier, officially from that first paycheck, but I didn't know what I know now. So I can only take what I know now and take it forward. So I'm doing the best with the information that I have now. And then I don't want you guys to repeat my mistakes. Make your own mistakes. So if I can prevent you from making the mistakes that I made, I'm going to do my damn well best. But yeah, make your own mistakes. So head over to my Twitter. It's like a little summary of FinTwit always. And that's me in a nutshell. I'm a mom, and my daughter's 13, and that's also why you see 13 years, because that's what woke up my lazy bum, is that I have a whole human that depends on me for everything. So it kickstarted my investment journey.
Brilliant. Thank you, Sophie, and thank you for your contribution. So retired 48, it sounds like you have the same sort of philosophy as Nozipho around retirement isn't an age. It's how did you get to that age of 48, and how do you know you're going to be able to retire at 48?
So it's very, very easy. So we call it your FIRE number, your financial independence retire early number. There's an amount of money that you need in your investment accounts to be able to retire, and you can never outlive that money. So if it's a well-diversified portfolio and you have 300 times your monthly expenses in liquid assets, so in shares, in money market, in bonds, if it's 300 times your monthly expenses, you can retire, and you withdraw 4% of that money annually. You can grow it by inflation, and you can continue living until the age of 300. That money will never get finished. So I know by the time I'm 48, I'm going to hit that 300 number. Every year I track how far am I to that number. Am I 10% there? Am I 20% there? Am I 50% there? So every year I track that number, and then I also do a forecast, and I see, what am I going to be investing? So I know by 48, I'm done.
Yeah, done. No, that's awesome. That's awesome. I'm going to work out my FIRE number just now. Yeah. So we're here to talk about RAs and TFSAs. So Sophie, tell us about your portfolio and how you've worked in your contributions and your financial journey when it comes to RAs and TFSAs, and how you decide between the two. If you do, how do you balance it?
Definitely. I have both in my portfolio, and both are very, very important. So guys, the products that Nozipho spoke about before, like ETFs and your bundles, they are found inside of an RA, inside of a tax-free savings account. So you can't really compare a RA to a unit trust. Those two are not comparable, because the one has products that goes into the other. So what I have done is, and this is also something that I just want to put out there, because it's a mistake I made with my very, very first job. I worked for Sasol, and I worked there for 4 years. I did my articles, and I worked another year. And then when I left, I took my pension fund. That is one of the biggest mistakes you can make. When you change jobs, do not take your provident fund or your pension fund and go and either blast it or buy a property, because I bought a property with it, and now a lot of people are going to say, but you did the right thing. I bought a property for about 50,000 Rand after I paid tax. That property is not even worth, after now it's 17 years, that property is not even worth 400,000. I'm telling you right now, if I put that money into my RA or into a TFSA, or if I put it into a preservation fund, I would be way further ahead. So when you change jobs, do not take that. So what I've done since is I've changed jobs, obviously, I think 4 or 5 times since 2006. I moved my money into either an RA, and we're going to talk about RAs now and Regulation 28, which is very, very important. Yeah, and then since the TFSA came, I think it was 2015, I opened a TFSA for my daughter, and I opened one for myself. So the first product that I max out every year, Craig and fellow investors, the first product from the 1st of March, the first 36,000 that I have for myself goes into my tax-free savings account. And the next 36,000 goes into my daughter's tax-free savings account. Tax is a killer. Tax is a stealer of joy. So I say tax, and in the same breath, Craig, fees, stealers, they are joy thieves. They don't want us to succeed. So whenever you think of your future, always think of the tax implications, because there are dire tax implications for taking your money out of your retirement funding. So whether your company has a provident fund or a pension fund, taking that money in cash has such negative implications. There are very few products, and I mean, you would literally have to become so lucky, and you can become lucky, but it's going to be 1 in a million people, you know, that takes their provident fund and buys Bitcoin and gets lucky. 99.99% of us are not going to get that lucky, and we are going to have to face the consequences of that decision that we made. My RA, so my tax-free, I max out first, and then my RA, I have a monthly contribution. I've always used PPS. So my RA has been with them. I was very negative about my RA at the beginning because of the fees. But once you see compounding starting to work, and that's where patience and discipline comes in, as you know, I just wanted to stop it. I couldn't take the fees anymore. I couldn't see the growth. But once you see compounding starting to kick in and really negate those fees, you know, you start feeling very positive of putting that 1,000 Rand a month into your RA, and then, you know, maxing out your tax-free savings account.
Thanks, Alfie. Yeah, I think from my perspective, when somebody leaves the employer, I usually have the rule where you don't take a retirement asset to fund a lifestyle asset. Your retirement asset should always remain in place. And it should never be used to, like you said, buy a car, buy a house, whatever the case is. So just the tax that you pay on it, and that capital value over a long period of time, it will take you a long time to make that up, right? So Sophie, the other thing you touched on there, your retirement annuity, just moving retirement annuities from various companies. I mean, there's a process called the Section 14 process, where you can move your RA from one insurer or one investment company to another. EasyEquities does offer that, so we put an in-house service where, if you've got an RA outside of there, it's got high fees, it's not performing well, it's not to your fancy, we can actually move that over onto EasyEquities, and it will be on your app and within that structure, which is quite cool, nice low cost. But besides that, tell us, let's focus on retirement annuities before we get into tax-free savings. So I think we have a lot of millennials, listening in and just sort of taking some lessons from us. Software. So millennials like flexibility. They like freedom of choice. Have you had conversations with millennials around retirement annuities and that it might be a bit sticky when it comes to accessing the money, and what have your responses and conversations been like with them?
Yes, so a lot of people, Craig, So this discussion always comes up, the fact that you cannot access your money until you are 55. Now, a lot of people see that in a negative way, but I don't. Some of us are just built like that. We are our own worst enemies. So I think Carly said it very well on one of your YouTube videos where she said, keeping your hand out of the cookie jar. Some of us are tempted by cookies, and you need to sit down with somebody or have some introspection and know that I'm the type of person that needs to lock money away. If you are that type of person, then an RA is a good product for you. But with EasyEquities now, and with so many, there's other platforms too, other companies, financial services companies, you just have this option of combining products. You just spoke about, you can move your RA to the EasyEquities platform. You can also have your TFSA on there. You can have your ZAR stocks on there. You can have your USD stocks on there, your ETFs. Everything is in one place. And a lot of millennials, myself included, we struggle with discipline. We struggle with consistency. And if something is out of reach for you, like, a lot of people do not check their provident fund statements. If they get it, they throw it on their desk. They never go into the website. So they don't have a handle on it. And what I love about EasyEquities is you can't ignore it, because if you are interested in your ZAR stocks, the chances are you're probably going to be interested if that TFSA is doing well, if that RA is doing well, so you get a better handle. It's about control. It's about millennials love control over their own things. Our parents had more of a hands-off approach. It's like, I just contribute to this provident fund and or this pension fund, and I see what I get at the end. We are a lot more hands-on. So having everything in one place, and having different products and exposed to different markets, it gives you a lot of flexibility. So even though you think you can't access this money till 55, think about all the other money that you can access till 55, and maybe not having access to this money until you're 55 is a good thing for you.
Cool. Thank you, Sophia. Keeping your hands out the cookie jar. I think, I agree that is one of the major benefits with the retirement annuity. So let's talk about some of the technical stuff, Sophia, with the retirement annuity. Let us know, what the contributions are. I'm thinking if somebody already contributes to a pension fund, what happens when I retire, maybe just a brief kind of overview on the technical stuff around a retirement annuity, if that's okay.
No problem. So with a retirement annuity, and I think Lizelle will also touch on this later, is you have to be very careful when you have a provident fund at work or a pension fund, and you also have a retirement annuity that you invest, in your personal capacity. So the first thing is you can only contribute 27.5% of either your taxable income or your total income, your remuneration. So let's make an example to make it easier. So let's say you earn 15,000 Rand a month, and your company says you must contribute 10% to your provident fund. It's one of the rules, okay? Then what happens is you obviously get a tax deduction on that. So it's a good thing to contribute to that provident fund at work. But now if you're also going into your personal capacity, you have to make a decision to say, what percentage can I? You can't go over, in total, the two can't be more than 27.5%. Or if you are really rich, the maximum is 350,000. So you just need to think about that. It's either 27.5% or 350,000, whichever one of the two is the highest amount. So if you look at my example, I actually wrote it down. So if you earn 15,000, then it means you earn 180,000 a year. If you contribute 10%, that's 1,500. That makes it 18,000 a year. Okay. So now if you also contribute to an RA, and here's where the nice thing kicks in about an RA, is you contribute, you decide, I have an extra 500 Rand. I'm going to put it into an RA. And why I'm going to say this is different than, putting it into single stocks. When you put that 500 Rand in, which is now 6,000 Rand a year, when you do your tax return, SARS is going to give you back 18%. Because you fall in the 18% tax bracket, SARS is going to give you back 1,080 Rand. You can do with that 1,080 Rand what you want. That's like getting a free 18% increase on your investment without doing anything. It's just from SARS. So if your investment goes up by 6% and SARS also gives you 18%, it means you've scored, and you can take that 18%, that 1,000 Rand, you can put it into your tax-free account, you can reinvest it into your RA and then just get paid again. So an RA has this added benefit of getting the tax back. When you have to wait once a year, but when you get it back, it's really, really up to you what you do with that tax refund.
Thanks, Solferi. I think just to add on to that, your contributions to your retirement annuity, they don't have to be monthly. You can also make ad hoc contributions to your retirement annuity, and it has exactly the same tax benefit at the end of the tax year. So, I'm thinking bonus time. Some of us, are lucky enough to get bonuses, and you can take a percentage of that, and you can, throw it into your retirement annuity and get a tax deduction on that straight away. So that's maybe something to consider as well. So moving on to TFSA. So you mentioned your daughter, has a tax-free savings account. Tell us a little bit around the benefits for a minor and the benefits to a major when it comes to a tax-free savings account and what to consider there.
So a lot of people have asked me this, because they've said that they were told that investing for a child in a tax-free savings account is bad for the child. Now, if compounding is bad for a child, then I don't know. Because the earlier you start, if you start a tax-free savings account for your child, let's say when they're born, it's going to take you 14 years. If you contribute the maximum, which is 36,000 Rand a year, so it's 36,000 Rand every year, and 500,000 over the lifetime, okay? So the only negative is your child won't be able to contribute because you've maxed out. By the time they turn 14, you've maxed out the 500,000. And then compounding happens. You sit back and you do absolutely nothing. You have good ETFs in there, it just starts compounding and it's in their name. And yes, the negative is they won't be able to contribute, but why would you want your child to start at 21 when you can start at 0? I would rather start for my child at 0 instead of them struggling at 21. I was on a very interesting space the other day and somebody said something that stuck in my head and it's probably going to stick for a very long time. And they said that a lot of parents think that education is the biggest thing that they need to help their children with. But when most of us need our parents the most financially is when big life events happen. And that is when we buy our first homes, when we turn 28, 29, when we have our first child, when you have your first child, you need to upgrade from a 1-bedroom to a 2-bedroom or a 3-bedroom or a house, when you need to buy a car. So most people need their parents financially more, at the age of, around your late 20s and your 30s. So the way I've set up my daughter's tax-free savings account is I know that I'm probably going to have to withdraw from it when she goes to university. And I'm okay with that. I know that. And compounding is already happening. She's turning, so I only started it in 2015. I know exactly when I'm going to hit, when she's going to hit the 500,000. And then when she turns 19, you know, we need to take some money out annually, and that is it. So I can't see, you know, somebody really needs to sit me down and explain to me why compounding, working earlier, getting interest on interest is bad for a child. I don't understand, you know, what the negatives are. So if somebody wants to sit down with me and just explain it to me, I'll be willing to listen. But for me, it is, you know, if that 500,000 grows at 10% a year, you know, you already heard when Nozi spoke earlier, and she said she's taking the 500,000 because in 25 years, it is 5 million, you know. So if I don't give that money to my daughter and she gets it at like 25, at like 40 years old or 45 years old, it's going to be 5 million. And that's a lot of money, you know, and it's going to keep on growing. So I don't see, you know, for me, I think the earlier you can start for your children, the better. If you can't max it out, that's fine. Then hand over the accounts to them when they, you know, when they are financially stable. So if you've only contributed 200,000 over their life, give them the account when they turn 25, you know, teach them financial principles so that they are responsible with the account, and they take it further for the other 300,000. And who knows, maybe SARS will increase the regulation someday and we can contribute more to the tax-free savings account.
Let's hope so. So fair, yeah, they haven't increased that amount in a while. So let's hope they do it and they're able to keep up with inflation a bit. I agree with you around the minor accounts. Yeah, compounding interest wins every time. So the sooner we start for our kids, the better. But in terms of us as taxpayers, just to recap, 36,000 Rand a year is the limit. Again, you can do it through debit order, or you can make an ad hoc contribution if you want to, or a combination of the two. And then there's a limit of 500,000 Rand over your lifetime, which I think you said might take, if you max it out every year, it's going to take you 14 years at that rate. So my next question is, should you use your tax-free savings account as an emergency account? And following on from that, do you think your tax-free savings account is a retirement vehicle?
So on the first question, no. On the second question, yes. And I'll explain myself. So your tax-free savings account can never be your emergency fund. I don't care what any other financial services provider tells you, it is dumb. If you take money out of your tax-free savings account, you can never put it back. So the tax-free savings account only works one way. It's money into the account, and money in is always 500,000. If you take 100,000 out, you can never put it back in the future, ever, ever, ever again, because it only works one way. And what do you do when you do that? You disturb compounding. What if you put your emergency fund into the markets? And what is happening right now with the S&P 500, with the NASDAQ? China is going crazy. If you have the MSCI China in there, if you have Russia and Ukraine are fighting like crazy, if you put your money in there, your hard-earned money, and you now have to take it out at a loss, that's going to hurt. Your emergency fund needs to be readily available. It needs to be in a separate account. You can't goal save for a holiday or save for a family vacation. So I totally don't agree with those principles. It must be, my tax-free savings account is the last place I would take money out of. And that is why the second answer is yes, Craig, because it is a retirement vehicle. It is, you know, we're going to talk about Regulation 28 now and what the government is trying to do there. But the reason for the tax-free savings account, the very essence of why they made this possible was so that less people are dependent on the government by the time they retire. So it's right there in the reason for the tax-free savings account existing. So just so just be very careful of that. You know, Don't goal save in there. You can't beat the market in there. You can't say, I'm going on holiday, I'm going to Australia in December, I'm going to put it in a tax-free savings account. If you take it out, you can never, ever put it back, on your ID number. It's just impossible.
Thank you, Sol. Very cool. So I think you wanted to chat a little bit about Reg 28. I'm just worried about time. Carly, Bonolo, how much more time do we have? 5 more minutes on our side?
You know what? We can do one more point and then we'll move on to the Q&A.
Cool. All right, cool. So to recap, we don't give advice. Your recommendation would be to max out your tax-free savings account and get that 36,000 Rand in there every tax year. And then look at contributing as much as you can to your retirement annuity during the course of the year. Is that pretty much your recommendation?
That's pretty much my recommendation. Is you want to benefit on tax for as long as possible. Tax avoidance, a lot of people, tax avoidance is, you have to do it. As a responsible citizen, you have to pay the least amount of tax every single year. You owe it to SARS to pay the least amount of tax every single year. And if you need to pay somebody to tell you how to pay the least amount of tax legally, do it.
Cool. The stealer of joy, as you put it, eh? Cool, Sophia. I just wanted to, huge thank you. I think we touched on some really good points there and some really great advice that you've shared, and I hope all our investors have learned something. Thanks for your time and for the way that you put things. It was excellent.
No problem. You are very welcome, and thanks for having me.
Absolute pleasure. Over to you, ladies.
Right. So we've been hearing a lot about tax. So we're going to talk about tax. We're going to get into it. Let's talk about tax, baby. And we have an expert in the house to do so. We're joined by Lizelle Steyn. She has got the 411 on all things tax. So Lizelle, I'm going to hand over to you. Enlighten us.
Hello, Carly. Thank you for, can you hear me okay?
Yes, we can hear you perfectly.
Oh, fantastic. Thank you again for this opportunity to speak today. Can I just say, I love your showstopper of an outfit, the whole ensemble. I think it would have stopped even the time machine.
Gee, gosh, thank you. just an average Friday for me,
I'd love to be in the office of you then. Soul Theory is a hard act to follow. So many gems that you dropped there. Thank you, Soul Theory and Craig, for all those good questions. Yes, today I don't want to spend too much time on tax, but more on how to avoid tax. And you must say, oh, what tax avoidance? Isn't that illegal? Just a reminder that we all want to avoid tax. Avoiding tax means to use all the laws that we have that allow us to minimize our tax or eliminate it completely. Whereas tax evasion is when we lie about our income. We say we didn't earn an income, or we understate our income, or we overstate our expenses to pay less tax. So what we're doing is legally, the legal term is avoiding tax wherever we can. So what are the main taxes that investors do pay if they are not in these two magnificent tax-free or tax-deferred products we've already mentioned, the tax-free savings account and the retirement annuity? What are the main taxes you as an investor would be paying without them? Locally, on your local investment income, there are 3 types of income taxes that investors need to pay attention to. Firstly, there is dividends tax. Everybody pays tax on local dividends. At our level, the level that we invest, of 20% of each dividend, which is a lot. It used to be 15% and it's been raised to 20%. There's also your the rental income. If you're in a property or a rate kind of real estate investment trust, there's that rental income. And that would be from the first rand to whatever your tax bracket, or the more technical term is your marginal income tax rate is. I'm going to get into that, what that is later. Thirdly, a third of the income is your interest income. I think that everybody knows. That's also your marginal income tax rate of everything that you earn above 23,800 Rand per tax year. So that's your 3 types of income locally. And then there's also capital gains. It's not an income, although it falls under the Income Tax Act. And that will be a maximum of 18% of your capital gain on your investment when you cash that investment in. So that's locally. And then on all your offshore investment products, you will pay dividends tax, a little bit more complicated offshore because you have double tax agreements, you have different jurisdictions, but you should not be paying more than 20% of dividends tax. That is not SAR's intention for you to pay more. So you might be able to claim some tax credits back. You also have your rental income, same as the local income. And then the difference between interest earned on your foreign investments and interest earned on your local investments is that from the very first dollar or euro, you are taxed on your interest. You don't have an exemption like you have on your local interest. And capital gains tax works the same as local capital gains tax. So what is this tax bracket that everybody is talking about? Self-Ferry also mentioned if your tax bracket is, for example, 18% in her example. Well, you can do a quick Google wherever you're sitting and just go SARS income tax tables. And you will get all the year's income tax tables coming up. And then you look at those are annual amounts in the table. And you look at what your annual income is. That would be your salary, your business income, your investment income, any rental property you have, you're renting out. Put all of those income figures together to get your total income for the year. And if that figure is, for example, 200,000 Rand, you will be in the 18% tax bracket. It will say there, everything above this is taxed at 18%. If you earn about 300,000, it's about 26%, and so it goes on. It's a sliding scale. Now, that doesn't mean that you pay, for example, if you are in, for example, the 26 tax bracket, that doesn't mean that you will pay 26% of all your income for the year. It just means that for everything you're earning extra now in this year, like, for example, that 1 Rand of offshore investment interest, you will be paying, if you're in the 26% tax bracket, you will be paying away 26 Rand for every 100 Rand that you got in offshore interest. That's your tax bracket. Also, the full term is your marginal income tax rate, just to clarify. So you might say, but why should I care about all this tax? I mean, can it really be that much? I say definitely all need to care. I've run some figures. I also like Self-Ferry, also like to run the figures and get my spreadsheets out. For example, if you are currently someone who can currently save 1,000 Rand a month, that's 12,000 Rand a year, and you keep that up for 30 years, your whole investing career. So in total you've put in 360,000 Rand split over 30 years. How much dividends tax do you think you would pay if all that money went into one of the products we've already mentioned, like the Satrix 40, for example, ETF? How much dividends tax do you think you would have paid over those 30 years if you invest 1,000 Rand a month into the Satrix 40? Well, assuming that you earn 10% per year on that product and that it was split 4% dividends, 6% capital growth, you would have paid away in dividends tax alone at 20% of your dividends, 300,000 Rand. You put in 360,000 Rand, you would have paid away 300,000 Rand in dividends tax. Fortunately, that capital growth is helping you, and you also it will be 1 point something million by the moment you take it out. But your dividends tax would have been 300,000. So just let that sink in. So then how do we actually avoid this tax completely, this dividends tax? We never want to pay that. Well, we've mentioned the 2 products, tax-free savings accounts and retirement annuities. We've already mentioned that currently very important, the limit that you're allowed to put into a tax-free savings account before SARS will send you a bill of 40% of everything extra is 36,000 Rand per year. I'm certainly looking out for next week's budget speak, next week, Wednesday, at 23rd of February. Our new Minister of Finance will be updating us on all things in the budget, and that also includes items that affect investors. For example, this annual limit on tax-free savings accounts. So we're keeping our fingers crossed that just perhaps he will raise that 36,000 Rand a year per tax year. It started out of 30,000 Rand a year in 2015, and then it was raised to 33,000, and now it's been 36,000 for a few years. So let's hope he raises that again. Let's see what happens. And that will then be applicable from 1 March, the next tax year, whatever our new tax limit is on tax-free savings accounts. Some people, the criticism that some people have of tax-free savings account, especially wealthier people, it's that they say, but it's so little. It's only 36,000 Rand a year. Well, if you started moving all your taxable products over to tax-free savings 7 years ago, when the product first came out in this country, you already would have had more than 200,000, and just keep on doing that every year until you're fully in a tax-free savings account. It starts to add up. Let's do the calc. Say, for example, you're somebody, I know it's a stretch limit for a lot of people to be able to invest 36,000 Rand per year, but let's say you are able to reach that target, and you keep that up until you've reached your lifetime allowance of 500,000. You will remember that Craig also mentioned that you can invest 500,000 over your lifetime currently. And so in year 14, you will hit that limit, assuming that the current, and this is a conservative assumption, which I'm quite sure it will be lifted, but assuming the cap stays at 36,000 Rand a year, and you invest that until year 14, and then you don't have to take your money out of your tax-free savings account. Just because you've reached your lifetime limit, you just leave it right there, and you leave it for, say, a 30-year investment career. That tax saving would, firstly, the 36,000 Rand you put in would have grown at 10% per year to more than 5 million after 30 years. So people who say, don't worry about tax-free, it's a small amount, they don't take into considerations compound interest and what happens to your investment after 30 years. Just leaving it in your tax-free savings account for as long as possible. So, but you wouldn't have had 5 million if you were in a normal taxable product. So, for example, you just put everything straight into the SATREX 40, not in a tax-free savings account. You would have paid away more than 1 million in dividends tax and also in capital gains tax when you took that money out after 30 years. So with the current caps of 36,000, your total tax saving, dividends tax and capital gains tax will be more than 1 million, assuming 10% growth per year, which is a very reasonable assumption, I think, to make. Then let's move on to our second tax-free product, and that is the retirement annuity. Now, the retirement annuity has so many tax freebies. I think we have to segment them, or tax benefits. We would have to break them up into 3 different parts. Firstly, there's the tax benefit in every year that you contribute money to your retirement annuity. And then the second phase, the retirement benefit while you stay invested, and the last phase, the benefit when you are retired or retiring. So let's first focus on the first phase. Every single year that you are putting a tax money into your RA, there's something called the tax refund. Now, I don't want to discriminate here. I'm sure we've got people here on the air tuning in to this webinar who are self-employed and people who are salaried, and their tax will work a little bit different on the RA, retirement annuity. Let's first tackle salaried people. Every month, your payroll administrator will calculate how much tax you have to pay based on the knowledge they have of your situation. So if you don't tell them, they won't know you are contributing to a tax-free savings account. So you'll be paying more money in tax than you need to. Only when you get your opportunity to do your e-filing in July this year, you can, now it's automated, so SARS should be able to receive from EasyEquities your tax certificate, and they will see how much money you put into your, on retirement annuity. They will see how much you contributed to your RA in this tax year, and then they will give you a refund. How much will that refund be? It will be the same as your marginal income tax rate, assuming you stay in that tax bracket. Your retirement contribution, if you contribute a lot, like 27.5%, it could also drag you down to a lower tax bracket, which is fantastic. We want that. But just to keep things simple, we now assume that you stay in the same tax bracket. Then for every 100 Rand, or every 100 Rand that you put into your retirement annuity, SARS will give you back in your bank account 36 Rand. If you put in 10,000, that will be 3,600 Rand if you're in the 36% tax bracket. If you're in the 41% tax bracket, you will get back 4,100 Rand for every 10,000 Rand you put in during the year. If you're in the 18% tax bracket, you will get back 18 Rand for every 100 or 1,800 for every 10,000 you put in. So the higher your tax bracket,
Hey guys.
I think we just might have lost Lizelle there a bit. You know, we can control our financial future, but we can never have control of technology. So we are going to try and get her back.
Let's give it a minute, and then otherwise we can jump into the Q&As and you can bring her back when she's here. Lizelle, are you there?
Hello,
there you go.
There you go. Back in the future.
All
back
right.
in the future. Sorry, just a little trick I want to talk about. If you want to start benefiting from your tax refund now, you don't want to wait till you file, go to your payroll administrator and tell them, listen here, I'm contributing so much to my Easy RA. Here's my proof. Could you please adjust my tax so that I start paying less tax now already and don't have to wait till I file? So you basically get your tax refund split over 12 months every month then. Let's see, a good administrator will be able to do that for you. So those are the salary people. The people who work for themselves, have their own businesses, they have to file provisional tax. And what you would do there then is you would deduct your RA contribution from your total income that you earned as a self-employed person, and that net amount you will give to SARS and only pay provisional tax on that. That's how it would work. Ferry also mentioned there is a limit. You can only enjoy tax relief, well, only, it's actually quite a big figure for most people, if up to 27.5% of your total income. That's your salary, your bonus, your business income, your rental income, your investment interest, everything you earn, put that all together, and you can get tax relief up to 27.5%. But if you are in a exceptional position where you can actually put more than that in, you say, for example, living with your parents, why not? Or you've got a house there set up that allows you to have very, very low expenses, and you can save more than 27.5%. Put in more, put in 30%, put in 40% into your RA. Why not? You won't get a tax penalty like with a tax-free savings account. And one day they will benefit you, and I will get to that third stage now. We've only spoken about the first benefit of an RA, and that's the tax refund or the tax relief now when you contribute. Also, the second phase is all those years, 30, 40 or 50 years, that your money stays in that retirement product. It works exactly like a tax-free savings account. You pay no tax on your dividends, no tax on your interest, no tax on rental income, no capital gains tax while you stay inside your retirement annuity. And this is the benefit that people actually don't talk about, but it's probably the biggest benefit of a retirement annuity, that it acts exactly like a tax-free savings account for all those years you remain inside your Easy RA or retirement fund, whatever retirement fund you choose. Now, those figures can get very big if you are somebody who is earning a bit more. And so, for example, you're able to put 120,000 Rand a year into your RA over 30 years. We're talking about a tax saving of 3 million Rand in dividends and 1 million in capital gains tax for somebody who's able to invest that kind of money into an RA. And people don't talk about, I call it the silent benefit of a retirement annuity. And then we get to the last phase. This is now actually when you retire and all your years in retirement. Firstly, the law says that I've already mentioned you cannot retire before age 55, but also remember you can have more than one R and you can retire from them at several different ages. You can stagger your retirement. Say, for example, you keep on working for your company, or maybe you scale down and you need money to fund your lifestyle because you're only working 2 or 3 days a week now. If you're already 55, just start retiring from your one retirement annuity and start using that income. You can phase it in over the years. You don't have to do everything in one, and you can keep, and you can retire from your RA without retiring from your company or your employer. Ferry mentioned retirement is not an age thing, it's a lifestyle choice for which we start preparing now already. So let's say, for example, you're somebody who wants to retire from your retirement annuity at age 55, then you can take only 1/3 of that money in your retirement annuity. You can take in cash. And this year that I recommend that you actually get a good financial tax advisor in at this point to decide how much to take, because only the first, well, not only, it's actually a lot of money, the first 500,000 Rand of that cash amount that you withdraw is taxed at 0%. It's a technicality. They don't call it tax-free, they call it taxed at 0%. So you will pay no tax on your first 500,000. Then on the next few 100,000, it's 18,000, 18%, then 26%, and so on. It's a sliding scale up to 36%. But I think your financial planner or tax advisor should help you at this point in your life to work out for you what is the amount you should withdraw in cash. I think the first 500,000, 0% is a no-brainer, but for the remainder, he or she needs to help you. Then you remember we mentioned that you can contribute more than 27.5% of your income into a retirement annuity, and that will help you later. Now, this is where it's going to help you. This is later. It's going to help you now because everything that you contributed, that's more than 27.5% of your income. SARS would have kept a record of that. They call it something like non-qualifying or excess contributions. They keep it in a kitty for you, Carly, or you, Bonolo. They will have your own account and they will have that figure. And that amount you can also take out at retirement at 0% tax. So it stayed in your retirement annuity all those years, hopefully decades. It was growing at 0 tax on your dividends, etc. And now you can take that money out too at 0% tax. That's a benefit that very few people actually talk about. Maybe because it's probably only the privileged few who can contribute more than 27.5% of their income to a retirement annuity. And then lastly, and this is the point that I know the critics of a retirement annuity harp on, now you unfortunately have to pay tax on the income, the regular monthly income you withdraw from your retirement annuity. But that is the deal with SARS. They've given you so many benefits, which I've just listed. Then the deal with SARS is that you will now pay income tax on that regular annuity income, on the remaining 2/3 that you have to keep invested. You will have to pay tax only on the money you take out as an income, and those rates will be exactly the same tables that you Googled a bit earlier, the SARS income tax tables. It will be the same rate. So, for example, again, if your annual amount you take out of your retirement funding is 200,000, you'll be in the 18% tax bracket. If you take out 300,000, you'll be in the 26% tax bracket. So yeah, and then lastly, people ask me, what should you prioritize, your tax-free savings account or your retirement annuity? Which one should you go for first? I 100% agree with Soul Fairy. First, prioritize your tax-free savings account. Try and reach that goal of 36,000 Rand per year. And then any money that you have extra to invest, put that into your retirement annuity. For people who are high net worth individuals, sometimes there are exceptions, and you can ask your tax planner to help you. Very few exceptions, it will be more beneficial to be in a retirement annuity first and then put excess into a tax-free savings account. But for the vast majority of us, the principle to follow is first tax-free savings account and then retirement annuity. And then hopefully you won't ever have any regrets about the decisions you made in the future. And that's all from my side.
Thank you so much, Lizelle. Whoa, that blows my mind. There's so many opportunities there to kind of take advantage of the benefits that these accounts offer. And we'd be crazy not to, is my thinking. but I'm good. I'm investing in my TFSA and my RA, so winning over here. Cool, guys. We've got stuck in today. We've actually gone quite a bit over time, so I'm going to try and quickly get into some of the questions we got today. You guys have been great. You've been posting loads. We unfortunately can't get to them all, so I'm going to just say, please go check out our EasyEquities blog, our support portal, our help center, where we've got loads of FAQs, and also our research portal, where we post research on ETFs and stocks, US, Australia, South African. So there's really a lot for you to go and sink your teeth into there. So if we don't get to your questions, I'm 100% sure you can find the answer you're looking for on our site. But we're going to get into it. We've picked our top 10 questions, and I'm going to go first. The question that we got, this question was from Sachin Munsami, and the question was, are bundle costs once off or are they ongoing? So maybe Craig, you can answer that for us.
Unmute myself. There we go. Thanks, Carl. So bundle costs, are they once off or are they ongoing costs? So the bundle fee is worked out as an annual fee, and it's paid once a year and deducted as a once-off amount at the beginning of the year.
Nice.
Awesome. And I'll take the second question. And the second question is from Naledi Nolwazi Zungo. And Naledi is asking, how do I choose an ETF or bundle? What are the right questions I should be asking? And where can I do the research? I think there's an ETF part there, so I'll hand over to Sean. Where can we, choose our ETFs or bundles?
So in order to choose our ETFs and bundles, you can head over to our two microsites, which is EasyETFs or EasyWealth. And that allows you to find the ETFs as well. When you find certain ones that you think you like, you can compare them against each other and see their different costs and the indexes they track and what they hold, which really makes it quite easy and simple way to analyze it in depth.
Nice, guys. Go check that out. EasyETFs and EasyWealth. So go check out those sites. Lots of information there for you. Okay, the next question is from Jonathan Dos Santos. He asks, do ETFs get managed like a bundle? Are they the same or is it different? And maybe Bongani, you can answer this one for us.
Yeah, so majority of ETFs are passively managed, meaning that they aren't necessarily looked after by a fund manager, but changes are applied when there are changes to the market. So if we take in the Satrix Top 40, for an example, that ETF tracks the top 40 performing companies in the JSE. But now if there's a change, if there's a shift, for example, let's say Steinhoff once upon a time was definitely, within the Satrix Top 40. But ever since all the allegations and everything, it's no longer a top performing share. But what happens is that it will get removed and replaced by another company. So one will go out, one will come in, or two will come out, two will go in. And that's just the passively managed ones. There are actively managed ETFs, which are in the pipe works. I'm not too sure whether or not this will be in this current year, be coming on the platform or not, but yeah, there is a difference between actively and passively managed ETFs. But currently, everything on the EasyEquities platform is passively managed. I hope that answers your question, Mr. Dos Santos.
Thank you so much for that, Bongani. And now I'm going to take Kabelo Masike's question. And he says, why no mention of ETNs? What are they and how do they differ from ETFs? Maybe Sean, you can take that one for us.
Thanks, B. Also, we haven't spoken about ETNs, and Craig might have to clarify me on this, as my main thing is ETFs, not ETNs, but ETN stands for Exchange Traded Note, and it doesn't the whole time as an ETF does. It only trades, I think it's end of day as well, if I'm correct there, Craig. And it is also managed instrument. It's not updated all the time. And we do have a blog on ETNs, and we can do a bit more research into them. I'll actually find the blog, put it on the bottom of the chat. Craig, I don't know if you have more to say there.
Yes, and then I think the biggest,
Craig, you go for it.
Yeah, the biggest thing with an ETN is it's almost like a bond. So it's a debt instrument. It's also listed on an exchange. They fluctuate very similar to what shares do and ETFs do. But there are some really good ETNs. We've got ETNs on our platform, and it is worthwhile looking into. But it's not geared for growth like an ETF is. It's more based around debt and bond structures. Bobo, anything else to add?
Yeah. I was just gonna basically say that another thing, the major theme for the ETNs is that they actually mostly do track commodities rather than shares and whatnot and stuff. So you'll find a commodity, an example would be oil or gold or silver, metals, precious metals. That's basically what the ETN tracks. So more or less following the same kind of structure as an ETF in the sense that it is tracking something, however, mostly geared towards the precious metals and commodities.
Nice. Okay, our next question comes from Zelda Senshaw. She asks, or he or she asks, if I want to hold something for 5 years, what's better, an ETF or a unit trust? What are some of the things to consider with that decision? I'm going to open it to Craig.
Thanks, Golly. That's a tough one. Unit trusts or ETFs are, I think, for 5 years. I think 5 years is a pretty good time frame to be invested in both, to be honest. It depends on which ETF and which unit trust. So for example, you could go into a money market unit trust, which is ideal for like 1 year, 2 year, 3 year, like an emergency, type account. Then you could go for a pure equity unit trust, which is then it's more beneficial to leave that in for 7 to 8 years. And then you've got a balanced unit trust, which is probably best suited for that 5 year kind of time horizon. And then you've got ETFs, which you could look at, which are also geared around 5 years, something which is maybe more conservatively invested than let's say the S&P 500 or the local top 40, where it's just pure shares, which is geared for long-term growth. So it's a tricky one. You could look at a property ETF, which that could be 5 years. There's so many options and so many considerations. I just think it's very dependent on your own personal risk appetite and what the goals are with the investment.
Thanks. Guys, it looks like we are running out of time. We only have a few minutes left. So we have noted all the good questions that you guys have asked. We've written down your names and we'll make sure we get those 100 Rand vouchers to you. I'll just ask one last question and then we're going to wrap things up. The question is from Hesse Stoffberg, and they've asked, I'm considering transferring my tax-free savings account to EasyEquities. What's the benefit of doing this over directly with another provider? For example, Signia. What are the benefits of having an RA with EasyEquities? Or TFSA, sorry, TFSA.
Whoops.
All right. Okay, first and foremost, cheaper fees. EasyEquities, we definitely boast and host the cheapest fees across the board for all accounts. So over and above that, you also have the benefit of managing investments yourself. You also have the benefit of being able to see the performance of your investments when and wherever you want to, as opposed to receiving a monthly statement or a yearly statement, which is common standard practice currently. And yeah, so, if you join the EasyEquities lifestyle and EasyEquities community, you'll get to see over and above the benefits that Lizelle pointed out, which was, the tax avoidance. But yeah, EasyEquities, the way to go. Cheap fees and managing your lifestyle. I think obviously awesome. The rest can add on. Sorry, Kwali, close up.
Awesome, guys. I think we're gonna have to wrap things up there. Before I go, and B, you can also give some last thoughts, but I just wanted to make you aware that up until the end of March, we're running an amazing competition where you can win your entire tax-free savings allocation. You can also win 50,000 Rand towards investing in your future. So please go and check out our landing page, Back to the Future You. It should be on our Twitter feed, on our social feeds. You can read more about the competition, but it's all about you guys and investing for your future. B, any final words from you?
Well, with all this knowledge from our futurists, you know, so much education, so much insight has been shared with us. There's no reason not to start investing. There's nothing to be afraid of. So don't go back in time, go back to the future. Look towards your future, towards building your financial future. And yeah, just start.
Thank you, everyone. Thank you to our speakers. Thank you to our guests. And thank you to you guys. You've made this an awesome session. And I couldn't agree with more. Someone just commented, this is the most productive Friday I've ever had. I have to concur. Thanks, everyone. We'll put the recording on YouTube and it'll be on that landing page I mentioned so you can rewatch and get all the good bits. But bye for now.
Bye.